a real estate professional can be one person inside of a marriage, correct? And still their married joint filed taxes can still receive that credit, correct?
Absolutely. Yeah. One spouse has to meet it, and then you can use it to offset the income of the other spouse who's not a real estate professional.
And so one thing that we talk about a lot, so me and Dan are very, very passionate about educating our military community. And there are a lot of spouses that stay home with the kids, that manage, just the household in general.
Yep.
So if they were to be the front runner in managing the properties and doing these types of things, that could be a conversation that they could have with their CPA where they could qualify potentially as a real estate professional.
Absolutely. Absolutely. Yeah. That's a home run scenario. You have a spouse that's can dedicate their time to managing the rentals, or at least managing the business.
Mm-hmm.
And, the other spouse is the one on the ground floor making it all happen. It's no pun intended, but a perfect marriage.
Hey, what's going on, guys? This is Dan Wynn,
Mike Glaspie,
with the Military Cashflow. Today we have a very special guest. It's my accountant, Mr. Nick Aiola. He's up there in New York City. It's actually pretty far east from me right now. I'm in New York as well. But Nick, would you like to please introduce yourself? Say a little bit about yourself, please.
Yeah, absolutely. Thank you guys for having me. As you said, my name is Nick Aiola. We run Aiola CPA, and we're a virtual CPA firm. We work exclusively with real estate investors, real estate businesses, and I invest in real estate also. So thanks for having me.
Yeah, thanks for coming on. I know you're going to provide a lot of value for the other investors out there. I've been talking to my buddies pretty much all this week about tax time. And I've been saying, hey, man, my guy, Nick, man, he's been killing my tax write-offs, dude. You got to talk to him. Talk to him. So trying to send some guys your way so you can help them out as well. But so let's talk about where you started at. How'd you, let's talk about how'd you get into accounting first, or how'd you get to become a CPA first, and then roll into how'd you marry that with real estate, or why'd you choose that specific niche?
Yeah, absolutely. So accounting, growing up, I always liked math, and that's how, most people equate accounting with math, right? So I always liked that. And when I was getting into college, the school I went to, you either had accounting or finance. Those are the two main business majors. So with an accounting degree, you can always do finance. With a finance degree, you can't always do accounting. So I figured, you know what, let's try this. And then, believe it or not, I like tax the best. And it's a little unconventional, but I always enjoyed tax. I always enjoyed the flow of it. And, then you realize that you could really help people along the way saving taxes. A lot of people don't know about taxes. And even if they do, they don't know how to save taxes. So it was always an interest to me. As far as the real estate goes, I kind of, I always grew up in real estate. My family's in real estate. I've always been interested in it. So as far as the accounting goes, becoming a CPA, I thought, man, the tax code, it's like 80,000 pages, right? 80,000 pages. How can I remember all this and help all these people in all these different industries? It just didn't make sense. It's impossible to do. So, I thought, let's truncate that and focus in on one industry that I like, something that I want to do, real estate investing, and let's know that really well. And then, I started investing myself, and you talk to people who are just like me, just like you guys, and you start to develop a specialization and more of an expertise that's focused in on one area. So, just over time, it just made more sense, focus in on one thing. And the same thing goes for real estate as an investor, right? Focus in on one thing, know that really well, and then master it. And that's exactly how, the decision was easy after realizing that, to just marry the two.
Yeah, Gary Keller, The One Thing, right?
Yeah, man. I love that book.
Let me ask you something. So I'm going to backtrack a little bit. You said while you're in school, you just started to really focus on accounting because you enjoyed it. What about accounting beyond just the math? Like, what was it for you? Did you have some inspiration, some awe-inspiring moment?
Oh, no, it wasn't a cool story, man. No cool story. I'm a bean counter at heart, man. I like putting things in different categories and making sure everything looks nice at the end of the year. And obviously when you're dealing with money, that's always a plus. So it just, I don't know, nothing special, no one thing. But actually, I had a few really good professors and they were all in the accounting field. So they made it a little more interesting, which is a hard thing to do. with accounting, especially as a college student, right? So yeah, that was it just wound up flowing that way, and it worked out.
Nice.
It's crazy. Tax code is like the most mysterious thing. And I say, there's a lot of advantages to real estate, right? We got the debt pay down, we got the appreciation, we got the cash flow.
Yep.
And then one of the things we got is taxes. And that's one of the very, very few talked about things, because just like you said, not too many people know much about it, especially when it comes to real estate, right? So what are some of the things that you most commonly see from real estate investors that they're not maybe using the best, or they're not taking advantage of certain tax codes the best?
Yeah, absolutely, and that's a great question. And just to touch on your point about taxes, not many real estate investors really getting too in depth on taxes, because most of the time, especially if you're a buy and hold investor, when you're analyzing your property taxes, you think property taxes, right? That's what you're thinking. That's what you're budgeting for. And then all of a sudden, at the end of the year, Uncle Sam knocks on the door and says, no, we got income taxes too. So that's something that we want to make sure that we always keep in mind, that we're monitoring that. And Dan, that we try to keep our handle on that throughout the year, make sure we're controlling that. And what's your tax liability going to be, and what can we do to mitigate that, right? So a lot of things you see with real estate investors, and taxes especially, it's so individualized, right? Everything that you do is dependent on your situation. You can have a similar portfolio to somebody else, but a completely different income situation, or maybe somebody's married and somebody isn't. You have a real estate professional, maybe somebody else has a W-2 job. These are all different things that you have to look at each situation, separately. And that's what I love about it. There's no cookie cutter or one size fits all strategy. So you really got to get in the nitty gritty. But a lot of common things we see is for the most basic, I guess, returns, and investors, especially buy and hold, is depreciation. We have so many returns that come across our desks without depreciation deductions, which means either there's no basis assigned to the property, or there is basis, and whoever was preparing the tax return, whether it was self-prepared or somebody else, didn't depreciate it. And what a lot of people don't know is that depreciation is not an option. It's required. So
let's break that down a little bit. Depreciation. I don't know anything about, to our listeners out there, let's just say I don't know anything at all about depreciation. Can you explain that? What does that really mean for me as an investor?
Excellent question. Yeah. So depreciation is basically how much are you able to write off the property over time? So when you purchase the property, you can't write that off all in year one. What the IRS does is they assign what's called a useful life to the property. Residential real estate is 27 and a half years. Commercial real estate is 39 years. So they're basically saying that's how long the property is going to last in the eyes of the IRS. So you take that purchase price and you allocate it over that useful life, and you get to write off a portion of that every year. The benefit of it, it's a non-cash deduction. So that's not coming out of your pocket. So you may be pocketing cash flow, but it's a tax write-off depreciation. So tax-free cash flow is certainly possible. It's very common with rental real estate, especially over here in New York with high prices. But yeah, that's the beauty of depreciation. And like I said, it isn't an option. You have to do it. So you get into things like when you sell the property, recapturing that depreciation, the IRS will recapture that whether you deducted it or not. So we want to make sure we get that figure right, we maximize it, and we take it every year that you can.
Exactly. So just breaking it down just one step further, again, for any listeners that have no idea what we're talking about right now. So if I have $100,000 that I brought in cash flow over the year on one of my properties, and then, the useful life for my 27 and a half year 4-unit residential home that's $10,000 for that specific year. I get to take $10,000 off of my taxable income, correct? Making it
absolutely right. Yep.
Making my taxable income now $90,000, meaning, well, in this situation, I'm probably not in a different tax bracket, but that $10,000 could make the difference between the percentage of taxes that you're paying overall, correct?
Yeah, absolutely. Absolutely. It plays an extremely important part. And you don't only have to depreciate the property. Any improvements you make to the property, any furniture you buy, if you're doing maybe short-term rentals, or any, equipment or whatever that any, rehab, renovation, anything that you could capitalize, that gets depreciated too. So yeah, it's definitely important to make sure you're capturing everything for sure.
This is a little bit more, I guess, a specific question. Now, is it for depreciation, in order to actually depreciate any type of item, is there a certain dollar amount that it first must exceed?
It depends on the asset. So generally, yes, you want to, the tipping point is $2,500. So if you have an expense that's under 2,500, in most cases, you can write that off in full. I say most cases because, as with anything in taxes, there's always exceptions. Mm-hmm. So you want to make sure that you're analyzing every transaction independently anyway, but that's a good general rule of thumb. If it's over 2,500, most likely you'll have to capitalize it. If it's, a betterment, adaptation, or restoration, that's the actual words the IRS uses. So you want to be sure that obviously you're looking at each payment made and each bill and invoice, but generally that's the rule. And to take it, I guess, one step further, it's not by payment. So if you have a contract that's $10,000 and you make 5 equal installments of $2,000, equal payments, you can't write off each one because each payment is under 2,500. It's the total contract value.
Perfect.
Yeah.
And what I really like there is you just said that everything in taxes is pretty much, there's always a loophole, or there's not necessarily a loophole, but there's another way to do it, right?
Right.
There's no one size fits all. And that right there, very specifically, you can say, hey, instead of depreciating this property because you've made so much taxable income, maybe we should just take it as a write-off for certain items, or maybe we can break it up and divide it. So that's why you guys need a CPA.
That's it right there.
Big time. Once you start acquiring properties, I definitely don't advise that you go at it alone. Nick had to amend 2 years worth of my taxes, because I
figured it out.
So I went out and tried to do it alone. I was not right. And one of the coolest things I think that you taught me, I learned from you, was about the, so I live in New York now, and I have properties in Georgia. And anytime I go down to Georgia to visit my properties, to do something that's associated with the upkeep of my property, it's a tax deductible expense. Can you expound on that, please? So and put that in the most layman's terms as possible, because I don't know if everyone really knows this, because I didn't know it at the time. So
definitely, yeah. Travel is a major deductible expense, and one that's often overlooked. So especially if you have out-of-state properties. So you can make your entire trip deductible if you structure it correctly. So when I say entire trip, I'm really referring to the cost of the travel. So maybe airfare, or whatever mode of transportation, and lodging when you get there. So in order to be 100% deductible, you just got to make sure the trip is over 50% business. So let's use an example, a weekend trip to go visit, one of your properties. If you have, you're setting aside 4 days to go visit the property, we got to make sure 3 of them are business, right? Over 50%. We want to make sure that it's primarily a business trip. It may sound a little hard to do at first, but if you really break it down, it's not. And the main reason being is because travel days are automatically business days. So your travel day there and your travel day back, it's automatically business. So that's 2 right there. So you really have to spend 1 day when you're there doing business stuff. And that's easy to fill as long as you have the right itinerary. So I'd always recommend, talking with your accountant before you go and saying, look, this is what I want to do. How can we structure this to make sure on paper this is deductible? And then you can write off 100% of your airfare, 100% of your lodging. You can write off your meals, 50% of your meals when you're over there, and any other business expenses you may have. If you attend a seminar or something, or you're taking a property manager out to lunch, or whatever it may be, those expenses are all deductible. And the most important thing, keep track of those receipts, keep track of your time logs, keep an itinerary, because as long as you're doing your record keeping, if you did get audited by chance, then it's not as scary as people make it out to be. As long as you have your records, you're in a good position.
Let me ask you a little bit about that. Just because you mentioned it, when auditing, everybody is scared of the big bad audit.
Yeah.
Like you said, though, as long as you keep your good records, your time logs, and all the receipts and all these other items, Is there a certain way that you recommend that the average everyday real estate investor maintains that type of document? Maybe an Excel spreadsheet. What's your suggestion?
Yeah, definitely. That's a great question. So as far as receipts go, I'd recommend digital. You don't want to be fumbling around with little pieces of paper all year, and then when your accountant asks you about a transaction in February, who knows if you even have it. So I always say digitize everything. Use cloud software that's free and available to you: Google Drive, Dropbox, iCloud, whatever you use. But make it organized. Use some kind of folder structure, right? Maybe do a folder for each year and then subfolders for each month. That way you can just snap a picture, put it into that folder. Maybe you jot down a little note on the receipt, or you name the file something. That way you remember it. And that way you can easily find it. If someone says, hey, what happened this month? What'd you buy? You can just go right to that folder and you'll know exactly what's there. That's the best thing for receipts. Believe it or not, the IRS actually doesn't require you to keep receipts under $75 unless it's for lodging. But I always recommend keep all receipts anyway, just to get yourself in that habit, right? Like anything else, it's human nature. You get yourself in the habit of snapping receipts, uploading it, it becomes, you don't even think about it anymore. So you just do it, and then that way you don't have to worry. Is this $74.99 or $75.01? You don't have to worry about that.
How long would you say to hold on to those receipts?
You don't have to hold on to them for I would say hold on to them for at least 5 years. A lot of people like to do it for 7 years. Some people like to do it for 10 years, but they don't take up too much space. So if you have that, that's why I say digitize everything. If you have it in a folder, it's pretty easy just to keep it. And then by the time, if you get to the point where you're filling up that cloud storage, you're probably safe to get rid of the older receipts. Yeah. And just Mike, to touch on your other one about time records, that's another important one. So if you're doing travel, time logs are super important. Journals, diaries. If you're a real estate professional, time logs are extremely important. So we see a lot of Excel spreadsheets. There are time tracking apps out there, but a lot of the time tracking apps are meant for, employer-employee relationships. I haven't found one that's self-time tracking that kind of does everything that I would look for as a CPA, and an investor. So if anyone out there knows, I'm happy to find out what that is, because I'd love to have that resource. But yeah, just be diligent with it, be practical with it. Excel spreadsheet is okay. Time in, time out, and description, and you're good to go.
Yes, I think that leads right into a perfect question, Mike. We were talking right before we got on about a question he had, but actually before we get to your question, Mike, just one thing that I guess, so I use QuickBooks, and for keeping records of my stuff. And really, I think you recommended that to me, Nick, because I suck at keeping track of all of my, all of my stuff. But the only thing that I don't like about QuickBooks though, is when you charge, anytime you charge something, it takes a while to actually upload to QuickBooks to take the picture to add to that actual transaction. But other than that, QuickBooks is really good as far as keeping track of everything, especially those things that are under $75. So
sure.
But QuickBooks also has a time log. Which leads perfectly into this next conversation. The reason I keep my time log is because I try to qualify as the real estate professional, which I would like for you to please expound on. Let our listeners know, what is a real estate professional?
Yeah. Okay. So real estate professional, this is one of the most widely debated topics in the code, in tax history, because it's exploitable. It's definitely auditable. So you want to make sure that you have all your ducks in a row with real estate professional. You don't want to mess around with real estate professional. There's a lot of nuances, and I won't bore the audience with all the details. So I'll try to be as general and I guess simplistic as possible as far as real estate professional goes. But basically, your starting point is 2 qualifications. The first being is, do you spend over 50% of your time in real estate related activities? The second one being, can you meet the 750 required hours per year in that real estate related activity? So you have to spend 750 hours, and over half your time has to be in real estate. This is where a lot of people get tripped up is the 50% one, the over half your time, is because it's impossible to do that with a full-time job. if you have a full-time job and you're a W-2 employee, 99% of the time you will lose in court. And there's court cases to prove that. So, it's just impossible I mean, certain people, I shouldn't say impossible, because certain people, maybe it's true, but the burden of proof is on you, the taxpayer, right? The IRS, they don't have to prove anything. They're going to come knocking on the door and say, okay, you make me believe this. And you have to make them believe it. So if you're working 40 hours a week at a W-2 job, it's way more than an uphill battle. It's like, 89-degree battle. So you want to make sure that and we see that all the time, full-time W-2 workers, real estate professional. And, the appeal there is that you're writing off rental losses against your W-2 income, but really you might be shooting yourself in the foot there. So you want to make sure that you can safely pass both of those tests.
So let me ask you this. So a real estate professional can be one person inside of a marriage, correct? And still their married joint filed taxes can still receive that credit, correct?
Absolutely. Yeah. One spouse has to meet it. And then you can use it to offset the income of the other spouse who's not a real estate professional.
And so one thing that we talk about a lot, so me and Dan are very, very passionate about educating our military community. And there are a lot of spouses that stay home with the kids, that manage, just the household in general. Yep. So if they were to be the front runner in managing the properties and doing these types of things, that could be a conversation that they could have with their CPA where they could qualify potentially as a real estate professional.
Absolutely. Yeah. That's a home run scenario. You have a spouse that's can dedicate their time to managing the rentals, or at least managing the business. Mm-hmm. And, the other spouse is the one on the ground floor making it all happen. It's no pun intended, but a perfect marriage. It really is. So you want to make sure that really when you're doing this, obviously the record keeping is important, right? The record keeping, the time log, that's all important. But you also have to look at your situation. There are instances where real estate professional is actually a negative consequence. You may not want to qualify for that. And there's certain examples. You want to make sure, first of all, your rentals, or whatever activity that usually it's rentals, your rentals are operating at a tax loss. If it's producing taxable income in excess of depreciation, the real estate professional status really isn't doing you too much good. Depending on your income, it may save you a little bit. But really it's not doing you any good, because the whole benefit of it is converting these losses that you normally couldn't deduct against other income into active losses that now you can deduct. So there are certain instances where it may not be the best option for everybody. So, we've come across certain clients who've come from firms who, and not to talk down on any other CPAs or anything like that, but, a lot of people like to push real estate professional down people's throats on an introductory call. And it's really not plausible. You have to make sure you're looking at every single detail. Like I said before, everybody's different. So you want to make sure it's, quality advice for that specific investor, and make sure it makes sense. And if it does, then you run away with it.
Nice.
Yeah.
That's definitely great. Is there any other way to possibly get around that? Like let's say I still want to claim some of my tax write-offs, or some of my vacancy write-offs, right? Or my vacancies. How else could you possibly write that off?
Yeah. So you're saying if you're not a real estate professional?
Yeah, if I'm not a real estate professional.
Yep. So if you're not a real estate professional, the IRS allows you to deduct up to $25,000 of rental losses against non-passive income. So that's, W-2 income, interest, dividends, anything that's not passive. Rental income is passive in nature. So you kind of have two buckets, passive and non-passive, and it's like oil and water. They don't mix. So passive losses can only offset passive income. So if you have rental losses, the IRS has a special exception for rentals that you can deduct $25,000 worth of those losses against non-passive income if your income is below $100,000. And that's joint or single. So if you're filing joint or if you're filing single, it's still that $100,000. If it's over $150,000, your income, you can't deduct those losses anymore. They carry over. You don't lose them, but you can't deduct that 25,000. And if it falls somewhere in the middle between 100 and 150, that $25,000 allowable loss, that phases out. So you may not be able to deduct all your losses. Maybe you'll be able to take some of it, depending on where you fall in that range. But that's a little, I guess, quirk in the tax code that allows you to possibly deduct real estate losses if you're not a real estate professional.
So
is
for
that 25? Sorry, go ahead.
No, go ahead.
Yeah, is that 25,000 in excess of depreciation, or does that include the depreciation as the loss?
So depreciation would be included in there. That's net after everything.
Okay.
Yep.
So for the average person, basically, you know, we can write off up to $25,000 if you're making less than $100,000. For the most part, for the average person with maybe one or two rental properties, they're able to write any vacancies they have off, correct?
Yeah, I mean, if you're total, you know, if you have a few months worth of vacancies and that means your gross rental income is a little bit lower than you expected, and therefore your expenses exceeded it, yeah, if you're under that 100,000, certainly you'll be able to have some. If you have a loss, you'll be able to deduct at least a portion of it.
Definitely.
Yeah,
definitely.
And,
So,
sorry,
go
Dan,
ahead.
go ahead.
No, go ahead.
I was just going to say one thing. Once you exceed that $150,000 mark, which is the point where you wouldn't be able to write off those $25,000 in rental losses, then you got to shift focus with a W-2, right? Then it's no longer, okay, maybe I can't qualify for a real estate professional. I can't deduct these losses. What do I do? Right now I have these rental properties. They're producing tax losses and I'm frustrated because I can't get any of the benefits. So that's the point where, like I said, you don't lose these losses. They carry over year after year, and you can use them in the future to offset passive income that you earn in the future. Or if you sell a property, you can offset some of the capital gain, or maybe all of it. But if you keep carrying over these losses, you want to make sure if you're continuing to invest, and a lot of us investors, the goal is to scale, right? Get to that passive income, financial freedom lifestyle. So if you're scaling, you can structure and strategize your next investments to see, you know, where is that going to fall cash flow wise? Where is that going to fall taxable income wise? Maybe I can generate more taxable income with an investment over here and use up some of these passive losses as opposed to an investment over here that's just going to create more of a loss carryover. And there are certain investments you can make. It doesn't always have to be rental real estate. It can be a passive investor in a friend's flip. If they're doing a flip, you can just be a passive investor. That's passive income to you. So there are ways to generate passive income to help you utilize those losses that you can't currently use. So there are certain things you can do to skate around that a little bit, but with a lot of things with the W-2, you know, you're a little limited.
So this might be a somewhat high level question, and I don't want to throw off the audience too much, but if you're going to sell a property and you continue to roll over these losses, some of these losses can be used to kind of offset the capital gain.
Yep.
If those losses were used and you still had a substantial capital gain profit, could you also use that in conjunction with a 1031 exchange or something else to kind of shield that taxable portion of the income?
Yeah, that's a great question. So if you're using a 1031 exchange,
let's break some of that down real quick. I know we're talking.
Yeah.
No, that's good. It's great, but like, yeah, let's explain some of these things. I know some people are like 1030. What the hell are you talking about? You know. So.
Yeah, absolutely. So 1031 exchange in the most basic form, it is very complicated section of the code, but in its most basic form, it allows you to exchange, quote unquote, one like-kind property. So you can basically sell a rental property and roll that money into a new rental property, one or multiple, and defer the gain on that sale. So it's not really a sale, it's an exchange. You don't have to exchange literally with the seller one property for the other. You can sell and then buy, but it allows you to defer that gain. So you keep rolling it over and you keep exchanging and you keep trading up and deferring the tax, and you're building your portfolio without any tax hit because you're not paying any capital gains tax. So to answer your question, Mike, if you did a 1031 exchange and you exchanged and deferred all taxes, you wouldn't use any of the carryover losses. It would defer everything. But there are certain times where you do exchanges and there's a portion of it that maybe you don't because with a 1031 exchange, I'll back up a little bit because I know it's a little confusing with all these code sections being thrown around and all these different tax words and lingo and everything. So I'll back up a little bit. But in order to defer 100% of your gain with a 1031 exchange, you have to trade up. So trade up in value. So if you're selling, let's just take it very simply. If you're selling a property that has no mortgage on it for $100,000, you got to take that and roll it into a property that's worth more. So if you traded down, you have what's called boot. So if you sold for $100,000 and exchanged for a property that's worth $90,000 when you paid for it, you have $10,000 worth of boot. And there's going to be a tax impact there. So if that's the case, then you can use some of your carryover losses to help offset that. But otherwise, you could defer everything.
Nice.
Yeah. I hope that was clear. I know it was a little tough topic.
No, that was great. I understood everything was going on, but I'm just trying to keep everybody in mind. Like, all right.
Yeah. I know.
So yeah, that's excellent. 1031 exchanges in trading up. The just taking a step back, just further step back. For the average investor, for the average military investor, we're talking about, they're doing their first and second property, and they're doing, they live in the property for, they PCS, they move, and they buy a house with the intent to fix it up, live in it, and then sell it. What are the tax implications there? Yeah.
So I guess it would depend on if there's a rental aspect to it. So if you're doing a house hack, if you're going to buy a multifamily unit property where maybe 2, 3, 4 units, and you're going to live in one, you're basically, for tax purposes, you have almost 2 separate purchases. So we're allocating everything between a personal side and a rental side. And Dan, did I understand the question correctly? Are we talking about multifamilies?
We can go into multifamily. That's fine too. I was talking more about like the live and flip, but house hacking is fine too.
Okay.
That's
okay. Okay, yeah. Well, we'll touch on both because it's a little bit different, but same idea, I guess. So I guess we'll start with the live and flip, since that was your original question. But if you go in and you're living in there and it's your primary residence, it depends on how long you stay there. So if you live in a primary residence for at least 2 out of the last 5 years, you have the ability to exclude a portion of, or depending on how big the deal is, all of the gain upon the sale. So if you're single, you can exclude up to $250,000 of capital gain. If you're married, it's $500,000. So if you do a live and flip and you live there for 2 years and then you sell it, and you're making, if you're single, if you're making a profit of less than $250,000, you can exclude that entire gain because it's your primary residence. Where you wouldn't be able to do that is if you sold it within, under 2 years. There are exclusions with that, especially, I know you have a military audience. So if you got called away for active duty, there are exceptions. But generally speaking, if you do it under 2 years, then you would have a capital gain element.
And that does not have to be 2 consecutive years, just 2 out of the 5.
Exactly. Yep. Great point. Yeah, it doesn't have to be 2 consecutive years, just 24 total months.
And that's really huge for the military service members listening, because obviously we do have PCS, or permanent change of station moves, that happen quite often. But there's times where you may just go on we call it TDY, or temporary duty assignment. They may come back. So they may be gone for a year doing a small project or a small assignment and then coming back. So everybody listening, keep that in mind. It's 2 out of the 5. I almost said consecutive.
Not consecutive. And there are special exclusions for active duty.
Okay.
So moving directly into the house hack is perfect. You said that. So I got 2 soldiers that they've actually watched my videos, and they bought duplexes. So both of them have a duplex. Shout out to Sergeant Wong and Specialist Ajit. So you guys see your name on the radio waves there. So hey, so these guys bought they bought great duplexes. They're living in one side and they're renting the other side out. Now when they go to move, actually, just go into the tax implications of just that. Like, what would your advice be to them just starting out, essentially, when it comes to, for tax purposes, basically, from, they've had a regular W-2 wage. Now they own a rental property and they're living in one side and renting the other side out. Does that change anything what they need to do as far as tax implications?
Yeah, certainly. So it's always important when you're doing a house hack or, owner occupying, that you be mindful of how what these expenses are really for. So what I mean is, do you have a direct expense for your rental unit? Do you have a direct expense for your personal unit, or do you have a common area expense? So it all comes down to good bookkeeping, good record keeping. We have an Excel spreadsheet that I like to give people who don't have, one or two properties. Usually you can get away with an Excel spreadsheet. Once you have a couple more, bookkeeping software is probably a little bit better. But as far as an Excel spreadsheet goes, you can just code each one, personal, rental, common area, because you do have to do that split. So it's, for tax purposes, it's almost like you have two separate properties, a personal primary residence and a rental. So we want to make sure that, we're putting the expenses where they go. We're taking the right amount of depreciation, especially if you're doing work to it. We're allocating the rental costs correctly, and maximizing, all tax deductions.
I think this is a good segue. I think it is. So we're just going to ride it. But let's say they're starting to grow their rental portfolio. They're getting a little bit more savvy on asset protection. So they go ahead and structure the LLC. Now, that LLC is its own entity. It's its own business. If they're going to operate their management of their entire LLC out of their home, can they take office deductions or office expenses on a portion of their home?
Yeah. So that's an excellent question. So home office deduction is, there's most people, if you're not an investor or if you're not a business owner, used to be able to take a home office deduction, even if they were a W-2 employee and they brought work home. They could just do it and write it off as an itemized deduction. But with the Tax Cuts and Jobs Act, the recent tax law change, they can't do that anymore. So now the home office deduction is only limited to people who run their own business.
Oh, I didn't know
that.
that.
So you can take it on schedule. Yeah. So a lot of people weren't too happy about that.
And when did that happen? When did that happen?
That was at the end of 2017. So
okay.
when the new tax law passed, and then in 18 and obviously 19, there's no more home office deduction. They did away with all unreimbursed employee expenses. So anything that you had as a W-2 employee that you didn't get reimbursed for from your employer, you used to be able to write it off. Even, miles, if you were driving, if you had a travel job, you can't write that off anymore unless you're self-employed. So that pissed a lot of people off, but
I try to educate a lot of the younger investors coming in. A lot of talk and a lot of hype goes around having that LLC or that entity, primarily for asset protection. And although that may be true, at a certain point, when you own your first property, that's all you have. You don't have a large retirement account. You don't have many assets. You're only really protecting the house. But I always try to tell them that LLC, by structuring that business, it now gives you more creative ways to now finance some things, because now that business can start earning its own line of, or its own credit. You have more tax deductions that you can take and everything else. So that, I did not know that you could only do it with an LLC, but that's
well, actually no. I should clarify, because you don't. It's not only the LLC; it's the classification of the income and how you're doing it. So really, believe it or not, an LLC doesn't give you any tax advantages or disadvantages. It doesn't help you tax-wise. Obviously, asset protection is great. Legal, it's great. But tax-wise, what's that?
It's how you incorporate, like the S Corp, C Corp.
Yeah, S Corp and C Corp will change your tax status and will change your tax impact, your tax liability in some way, shape, or form, whether it helps you or hurts you. I've seen it both ways. But an LLC really, really won't do that, because it all passes through to you. So it's the nature of the income that will allow you to take the home office deduction. Is it W-2 income? You can't take it in that case. Or is it investment or self-employed income? Then you have a case to take it. So the LLC is certainly helpful, but it doesn't allow you to take any more tax deductions than you would be entitled to otherwise. And I hear that a lot too. It's a great thing you brought that up, Mike, because people say, I formed this LLC so I can deduct my property taxes and mortgage interest and insurance, but you really didn't have to. So entity structuring is very personalized too. Certain people like LLCs, certain people like umbrella insurance policies, what works for the investor. But definitely you're entitled to your tax deductions regardless.
Love it. Gosh,
Yeah.
full of nuggets.
Yeah,
Full
that's a huge common misconception. I think I didn't know that until you told me that. I think a while back actually. So as far as the pass through, so
Yeah.
yeah, that's awesome.
But they're still important. Protect those assets.
Absolutely. Absolutely.
Worked hard for them, right?
Yeah.
Absolutely. Don't let anybody take them.
Yep, exactly.
All right, Nick. So if there was one piece of advice that you could give to the person that's just starting out investing, just bought their first rental home, what would that be?
Okay. Am I putting on the CPA hat or the investor hat for this?
Let's give two pieces. One's a CPA, one with the CPA hat on, the other with just the regular investor hat on.
Okay, let's do the CPA first since we've been talking about taxes. So my CPA hat advice, that would be analyze your opportunity costs. Don't be afraid to spend money. So if you're building a team, you need a team around you, right? If you're building a team of professionals, whether it's a CPA, an attorney, property manager, lenders, whatever it is, understand the value in that. What is it costing you to save money up front in opportunity cost? Are you doing something wrong? Are you leaving money on the table? Are you exposing yourself? Hire out professionals that can help you. It only makes scaling easier. When I talk about that for taxes, what I tell people is tax prep is a cost, right? That's going to save you time. You're hiring something out to a professional who can do it. But tax planning, tax strategizing, that's an investment. So when you're putting your money into tax planning, you should expect, and that's how we approach it anyway on the other side of it, you should expect to receive that amount of money back, plus more, hopefully, whether now or in the future, in tax savings. So you're an investor, right? So think of it as an investment. When you're building your portfolio, don't be afraid or don't be spooked by onboarding all these professionals at once, because it's only freeing up your time to build your portfolio and do the things that are important. That's where your value is, building that portfolio, making those investments.
That's key. That's huge. That's a great piece of advice.
I love that. I don't think I've ever heard it quite phrased that way, but it's so true at any scale, period. Even when you're looking at large corporations, what do they have? They have accounting departments. They have, their sales department, is because they understand the power of that, of leveraging through those, well, for them, it's employees, but it's the same concept. You as an investor, you're building a business. You need to have qualified individuals in those positions.
You said it. Yeah, it's super important. And if you have 10, 15, 20 doors, by the time you say, okay, man, wow, I think I need a CPA now, it could be more costly, more time consuming to kind of go back and restructure anything. Same thing with an attorney. Like, what entity structure are you using? So I always recommend that. Obviously, it sounds biased coming from a CPA, right? But it's just good business, best practice as a business owner, as an investor. And I guess, speaking of, Dan, to put the investor hat on now, to give one more piece of advice, I guess, would be take action. And this is from personal experience. I sat in analysis paralysis for so long, and you see these good deals come and go, but maybe they're not exactly what you're looking for. And it's okay to be picky. Obviously, you got to make sure the numbers work. I'm an accountant, so I can definitely attest to that. But don't be afraid to take action. Because then you start to get focused on maybe one perfect deal, and if it doesn't work out, you're discouraged. Maybe it takes you even longer to continue on. But just know what you want to do and then get after it.
I love that one so much. Taking action. Dan can attest to it. My one piece is the same thing, is take action.
Yeah.
Because like you said, that first deal, you may have a smaller margin, but you learned something. And more importantly, as you continue to grow, you get a hell of a lot more creative. Now, all of a sudden, you may be able to carve out, 2 or 3% higher return by just doing something differently than, what you would have done before. So I love it. That's good stuff.
Yeah, exactly.
That's the number one. I just finished the military cash flow course, and I say take action maybe, I think, at the beginning of every single lesson. Hey, you got at the end of the thing, I say take action like 8 times, just and go into detail. Because just like Mike said, just like you said, if you're not attempting to do it, you're never going to learn. Every single time you do a transaction, even if you fail a little bit, you're sharpening your tools and you're getting yourself better and more prepared for the next time, for that next deal. It's just making you so much better. You're failing forward. We had my buddy Quentin Judson on. He was talking about that, failing forward.
I like that.
That's L. It's not people think of taking L as a loss, but it's not a loss. It's a lesson learned, right? Yeah. So
Absolutely.
the L is the lesson.
I'm gonna steal that one from you, Dan.
Yeah. So, but hey, it's been great having you on, Nick. Can you please tell some of our listeners where we can find you at, or how we can find out more about you?
Yeah, absolutely. Luckily I have a pretty unique last name, so it's easy enough to find me. Our website's aiolacpa.com, AIOLA-CPA.com. There you'll find all our social media handles and whatnot, direct contact information from me. So yeah, always happy to help. Always poking around on Bigger Pockets, active on the forums. You can find me on there too, LinkedIn. Everything's just under my name, Nick Aiola or Nicholas Aiola. And yeah, you can find me there.
All right, and you'll find out all his tags right below, and then his information will also be in the notes section. So make sure to check that out. If you're watching this on YouTube or listening on podcast, make sure to leave us a like, leave us a share and subscribe. So we appreciate that. Leave some comments, share your love. I know Nick will be watching, or we'll see the video. So if you have any questions, you can write a question, and I'm sure he'll reach right back out to you. So with that, this is Dan Wynn.
Mike Glaspie
signing off.
Thanks for having me, guys.